My name is Peter Higgins. I'm the host of the Investing Matters podcast. Today we're going to talk about how undervalued the UK stock market is. And I've got a stellar panel for you. I've got George O'Connor coming up first, Research Analyst at Progressive Research, followed by Charlie Huggins, Head of Equities at Wealth Club, followed by Gervais Williams, Head of Equities at Premier Miton Investors, and then we've got Stephen Yu, Lead Manager of Blue Whale Growth Fund. We're very short on time, so I'm just going to get straight into it and introduce my first guest. Can I have a round of applause for George O'Connor, please?
Hey there, Peter. Many thanks for the opportunity, and good afternoon, everyone. Can I have a small indulgence before we do anything? I recently joined Progressive, and our founder, Gareth, is here. Now, I say that, and I've taken my glasses off, so he's here somewhere. If anyone's got a business card, give them all to Gareth on the way out. In terms of the bad news, Peter, I don't even believe in your core proposition. Is the UK, and I speak from a tech side, is the UK market cheap? Who cares? Tech is a story of fundamentals and sentiment. You've got to get both of those right in terms of coming up with an interesting investment case on a tech stock. Who wants to wake up every morning next to a zombie stock? Who wants to spend their time in a value trap? And that has been the story in terms of the UK market for a while. When did sentiment change? Probably back end of 2021, if you can remember what happened then, was the interest rate environment changed. As the cost of capital went up for the sector, the returns started to fall away pretty quickly. So one of my poorest years was 2022. TSR was minus 22%. Since then, the macro has been not the big story, but pretty much the only story in terms of the tech sector. And in terms of where we are today, higher for longer translates to lower for longer from a valuation perspective. Currently, in terms of my patch, stocks are trading on a PE of around 19. If I look over the long term, so let's just forget about .com for a minute, so look for a long term, so start the clock at 2002, sort of average PE has been somewhere between 17 and 19. On a high part of the cycle, it can go straight up to 27. So yeah, it's cheap, but if there's no momentum in there, does it really count? So what we need is really for the macro environment to start changing, and then we've got a great trigger event. Sell-side people, investment bankers, tech guys have been saying for a long time, sector's cheap, when in fact it's been really expensive. This is sort of the first time we can say convincingly, tech looks really cheap. In addition to that, we're at the start of a new tech cycle driven by Gen AI. Just for a slight moment, let's think about what Gen AI is. On one side, it's a big store of memory. On the second side, it's something that deals with plausibility, not facts. On the third side, it deals with hallucinations. I mean, I've scored 3 out of 3 in terms of what I bring to that party. If we look and think about use cases, I think the most current is Klarna. I don't know if you know or use Klarna, buy now, pay later, maybe pay forever. But they've been in the press talking about saving 40 million US on their bottom line. And that was on the back of a chat GPT implementation. They've managed to take out 700 of their call center staff. I've been working in investment banking for about 20 years. Most of that, my life, was really in a call center. Gen AI gives us a white collar revolution. In addition to a great valuation story, in addition to a great story around the start of a new tech cycle, we also have the notion that possibly the interest rate environment starts to come down. If it does come down, we've got a great trigger. I'm in the waiting room, just like the rest of you. Tech sector sentiment has started to budge. If we look at it from a sort of a TSR perspective, in terms of year to date for me, we're at plus 3.5. Now you can't say that's nothing, but it's, you know, the compare is minus 22% in 2022 and minus 9.7% in 2023. So it's moving in the right area. In terms of stocks, because that's what I do stock picking, I still think we're in for a little bit of a fragile time this year. Macro isn't great. Now, in fairness, for reporting season, it's been okay. There's always a couple of howlers, so we've had a few howlers. But generally, I'd want to be more on this sort of on the risk off rather than risk on until we get that trigger. If you're looking at sort of larger companies, stuff like Computer Center, we've had in the semis industry the great unwind. And that's really around supply chains and how that's impacted someone like Computer Center from a reselling side. It means they've been able to work down their inventory. And from that, there's bags of cash there. So that bags of cash should turn into a special dividend. If you're looking sort of for lower down in terms of market caps, some of the themes we really like, the sort of the secular drive on cloud, something called Beeks Financial, if you're looking there, great story in terms of future earnings upgrades. A company called Oxford Metrics is another one, not in IIS, but really well positioned. In terms of the sort of what we did post-COVID, we all went traveling. So in there, sort of in terms of travel tech, something like a Hostel World looks really well positioned and cheap as well. In terms of other areas, the IT services side have been absolutely battered from a valuation perspective. They are cheap, but they don't have any momentum this year because the players in that, stuff like Kainos or Made Tech or TPX Impact, tied into sort of UK budget. This is a sort of UK public sector budget. This is a sort of an election year, so have a bit of a pullback in terms of spend. Clearly, you're spending up to the 31st of March in terms of the public sector market, but sentiment will remain poor. But elections do tend to play out. There is a winner. Spend starts again next year, so I would look at them for next year. In terms of avoids, sort of Darktrace and Sage from the top end in terms of the wild card. Capita, new CEO in there. Adolfo has come out of Amazon. If anyone gets and understands Gen AI, he does. There's a sort of a CMD event in June. That should be wall to wall about Gen AI. I've left the room. I thought I was doing so well, but I've done.
Fantastic. Ladies and gents, can you give me one question, please, for George regarding his presentation? And we'll do that for each presentation going forward. Anybody got bold enough to give George one question? You've answered all the questions, George.
Thank you very
so much. Ladies and gents, George O'Connor. My next guest is Charlie Huggins from the Wealth Club. Charlie, go for it.
Thanks, Peter. So my little talk is about whether to invest in the UK. Should you invest in the UK? I think in order to answer that question, you need to understand what the subcomponents of the UK market are. It's no good saying broad brush terms, should you invest in the UK? So I plan to just spend a little bit of time just going through some of the major sectors in the UK, give you my views for whatever they're worth. So the financials is about 25% of the FTSE All-Share Index, of which banks are a major part of that. Personally, I don't like banks. I don't think banks are a good place to invest. Very competitive sector, very cyclical, very financially leveraged. Dividend yields high, yes, but at the mercy of regulators. Regulation is a constant and growing threat for the banks. So big part of the UK market, banks, personally, in my portfolio, which is a global portfolio, I do not own any banks. Basic materials and energy, which is about 25% of the FTSE All-Share Index lumped together. Better than banks, but still a lot of risk in those sectors. Very cyclical, very capital intensive, constantly having to spend to replenish and grow production. returns on that spending uncertain because no one knows what's going to happen to commodity prices. So won't surprise you to know I don't own any basic materials or energy in my portfolio. Consumer staples is another big part of the UK index. And historically, that has been quite a reliable place to invest. But challenges here too, risks growing for that sector, arguably. Tobacco, Imperial Brands and BATs being the main ones in the UK, facing huge challenges navigating this transition from combustibles to next generation products. Very uncertain how that's going to play out. Layer on a fraught regulatory landscape on top and a lot of financial leverage. Not one for the faint-hearted. Even Unilever and Reckitt face growing risks and are finding life harder today than they were, say, 5 or 10 years ago, in my opinion. The internet opened the playing field for smaller, more agile peers. Private label competition in a cost of living crisis has arguably never been more intense, and consumers are increasingly fickle. Very little consumer loyalty now towards big brands, even people going away from, say, Heinz beans. So consumer staples giants having to run harder just to stand still. And then final sector I'll touch on, healthcare, dominated in the UK by GlaxoSmithKline and AstraZeneca. The success of these will always live or die by the drug pipelines, and that's very difficult to predict. I did a biochemistry degree, and I can't do it. So success can also be a double-edged sword for that sector. So you get a blockbuster drug, but then it comes off patent, and then new competition enters, generic competition enters, and then sales for the key drugs start to decline. This happened with AstraZeneca. So the UK as a whole, in my view, is an uninspiring place to invest. You look at the long-term prospects for most of the major sectors, and they are questionable. The UK market does not have anything close to a Nvidia, Microsoft, Apple. However, I'm not total bear on the UK, you might be surprised to learn. There are gems to be found in the UK market.
Hooray!
So 40% of my quality shares portfolio, which is a 15-stock global portfolio, 40% of the names are UK listed, including one or two that I'm about to mention. So one of the best run retailers in the world, Amazon, maybe, Next PLC, run by Simon Wolfson for the last 2.5 decades. Exceptional CEO, exceptional business. In contract catering, I'm not aware of anyone better than Compass Group. Contract catering is a sector where scale really matters, and Compass is the market leader, by far the global market leader in contract catering. And it has a very, very strong market position, and that's a UK-listed business. The UK is not known for its technology businesses, but there are some exceptional technology businesses here in the UK, including Data Titans, Relics, and Experian. These two businesses are unparalleled globally. They are market leaders within their sectors. Not aware of any businesses that are better than those two in what they do, and they have exceptional long-term prospects, in my view. And let's not forget, the UK is also home to some phenomenal industrial businesses. Halma, Spirax-Sarco, the steam specialist, has a fantastic bioprocessing business as well, biotechnology business. Specialist distributor Diploma. You won't find many industrial businesses globally with a better long-term track record than those. So, overall summary, UK, if you're looking for a broad brush way to invest, I personally would not invest in the UK. I would invest in a US or World Tracker, or buy Stephen Hughes fund, or mine. But if you're going to be very selective, if you're going to cast your net far and wide, then the UK does have some exceptional businesses.
Ladies and gents, thank you very much for Charlie Higgins. Whilst Charlie takes a seat, have you got a question for Charlie? Anybody?
Yeah, if no one has, I have.
Go for it. Make it a good one.
Yeah, you mentioned that 40% of your stock is, I mean, globally you are, 40% is in the UK market.
Yes.
And in the end, you said, if I were you, I wouldn't invest in the UK market.
Yes.
So what made that paradigm shift, you know,
So
in
what,
your
what
thinking?
yes, good question. So what I mean by I would not invest in the UK, I would not invest in a UK tracker. Because if you invest in a UK passive FTSE All-Share tracker, you get the sectors that I just mentioned, the oils and the banks and the commodities. If you're an active manager like me, I couldn't care less where a company is listed, and I couldn't really care less where the sales come from. I'm just looking for the best businesses I can find, and I find some very, very good ones in the UK because I've been following the UK market for probably 15, 20 years. So, yeah, there are some great businesses there. You've got to go looking for them.
Thank you for the question. Thank you for the answer there, Charlie. Ladies and gentlemen, we've got Gervais Williams, Head of Equities, Premier Miton Investors. Can I have a round of applause for
Thank you very much.
Gervais Williams, please?
Thanks for coming along today. Well, you've heard from George and Charlie, really, but sort of similar. The UK is full of relatively dull companies which don't grow properly. And I could have said that 5 and 10 years ago, and it, you know, obviously it may carry on. As it happens, though, you've got to be careful with stock markets. They don't just do the same thing year in, year out. They have long periods, actually, when stock markets actually outperform. If you take the last 10 or 20 years, nearly all global markets have outperformed inflation, something rotten. But there's lots of other periods when markets flatline, sometimes 5, 10 years. If you take it in real terms, discounting for inflation, between 1900 and 1950, the US stock market, S&P, full of these tech stocks we've just heard about, didn't go up for 50 years, right? You've got to be very careful about assuming that the tailwind will always be there. I don't think it will be. I think globalization, tailwind, accept that. Beyond globalization, absolutely no. You've got to be very careful about the tailwind. I don't think the tailwind's going to be there. So I think we're going to go into a period of change. Specifically, I think, the compromises of globalization have become politics, and politics really means that we're all reshoring. That's bringing in inflation. We've got sort of nationalistic agendas. We don't really care about our neighbours. We care about ourselves first. You get geopolitical events. And, of course, you get lots of immigration control, more inflation. And we saw what happened in 22 to George's portfolio is it went down. Right? So my assumption is, actually, that we're going to be in a period of beyond globalisation from here. And if we go beyond globalisation, then in my view, yes, you can get some tech stocks and some may outperform, but specifically, the companies which actually have more advantage than most people think are companies which actually are capital intensive. What do I mean by that? Not just mining companies, but financials, some manufacturing, some defence companies, certain mining companies as well, accept that. But the great advantage is the more interest rates go up and the more they stay up, actually, the harder it is actually to put capital into these businesses, the more advantage you have as a capital business. So if you go back to the 60s and 70s, and let's remember the UK economy was pretty rubbish in that period. We had 3-day weeks. We actually ran out of money, just like Argentina. The IMF had to rescue us in 1976. But actually, the UK stock market, full of these very boring and dull companies, because they're capital intensive, cash compounding works really well when capital is short, the UK market was pretty much the best in the world. And it was still very boring companies, probably a little bit more boring in those days. So actually, I think the UK market is going to outperform. It's disgustingly cheap. We know that. I could have said that 5 and 10 years ago. But most particularly, beyond globalisation, the politics is coming through. It's making a bigger and bigger difference. And so really, actually, it's not just about the UK outperforming. And don't get me wrong, it's not the UK economy I'm talking about. I'm talking about the UK stock market. But on top of that, of course, beyond globalisation, we've had too much bigness during globalisation. We need more smallness. It just so happens the UK market is dominant, not just in capital-intensive income compounders at the top, but most particularly as you move down the market cap range, yes, you can get some mid-cap, but nearly unique in the world, you can get into the smaller micro-cap. And the smaller the company, the better the performance. They're standing on crazily low valuations. If you take since the end of 2021, effectively, small caps have had a surge of sellers. There aren't many buyers. Effectively, the AIM market, the FTSE AIM market, has underperformed the FTSE 100 by 60 or 65%. It's just amazing. I'm more bullish now than I've been for 30 years. Not just for the UK stock market, but most particularly for small micro. I think we're sitting on a gold mine. We just don't happen to know it. And the advantage of these companies isn't just that they survive, some of them succeed. The tougher it gets, the more opportunities to buy acquisitions. We heard from George about Next. Actually, it may have been Charlie. Next is a brilliant business. They've just bought some companies from receivership. It's great buying them from receivership. You pay very little money. So Made.com or whatever they paid 3.2 or 3.4 million for. That was a business which had been valued at, say, 500 or 600 million, probably only worth 300 now. If you're 9 billion market cap, it's great to make an acquisition adding 300 million. Great stuff. But just think about a 300 million pound company doing the same deal. The uplift is so great, so much greater. And if you're a 30 million pound company, okay, you may need to raise 30 or 50 million to actually do the deal, but the upside is transformational to your profits. That's what happened in the 70s. The small cap sector was the best performing part of the best performing market in the world. That's what I think is coming. We're sitting on companies which are disgustingly cheap, which could start with the option value, that upside option value, to come through. Another example of a company which has already succeeded, I think will continue to succeed, a company called U Group. You probably don't know it. It's a utility company. It's a bit like British Gas, it's a bit like E.ON, except it's tiny. It just serves the corporate sector. It did have a wobble. The share price went down to 18 million market cap. This was in 2020 with the wobble in the market. This year it's just finished. It's got 80 million cash in the balance sheet, no debt. The forecasts are that they'll have 110 or 111 million of cash at the end of this year. It's just started. About 141 according to the analysts. I think they're too low. I may be wrong. So the share price isn't 18 million, okay, just so you know. The share price is about just over 200. It's gone up over tenfold. It's gone up twice as fast, actually, as Nvidia, just so you know. So you get this option value in small micro caps. They're just sitting out there. Go and do the work. You'll love it. Thank you very much today.
Okay.
Anyone got one question?
Go to Kevin, please.
Hi, Gervais. It seemed as if a lot of the selling in the market, in the small cap sector in particular, has been because of forced selling to satisfy redemptions.
That's exactly right.
Can you give us an indication of where you think that trend is heading at this point in time?
Yes, I mean, what we've seen really is capital follows returns. So what we've seen over the last 30 years, of course, is globalization. We've seen mega caps, more indexation that favours, as active funds redeemed, passive funds are bought, you overweight, or you put more capital into the large companies. So you get this mega cap trend. It's not just in the US, actually. You can use European companies as well, Novo Nordisk and all that kind of stuff. So anyway, it's a very significant trend. And people, when you get a turn, people are slow to do the turn. So we've got the kind of clearing at the bottom of the market. So there's still a few people selling. Just about everyone internationally has come out of the UK. There's hardly any active managers. They might have a few Shell rather than, I don't know, perhaps a US equivalent, perhaps Chevron or something. But most particularly, nearly everyone's sold internationally. Local investors, they do have an overweight position in the UK, and they've been embarrassed. They've got a lot of scar tissue. They keep selling. So we are actually at that period where they keep selling. So what I'm looking for, actually, of course, is for even a slight reduction in selling, because I think at that stage we're on a hair's trigger. The market breaks out on the upside, just like Japan, and then the sellers just think, you know what, I'm going to hold back. I'm going to hold back just to see what happens. And when they hold back, of course, the market roofs it because they're not selling any longer. So you've got this unstable equilibrium. When is it going to finish? I was rather hoping the budget would actually bring in the ISA. It's only 5,000, but I was rather hoping they'd do it for the new tax year. We're into consultation. It'll be next year. So I think it'll just be takeovers which started. We're starting to see almost one a day now. And that cash will come through. And as soon as those takeovers overwhelm the local sellers, then you get this hair trigger, market breaks out on the upside, sellers dry up, and we're on our way.
Brilliant reply. Thank you ever so much,
Thanks.
Gervais.
Thank you.
Ladies and gentlemen, Gervais Williams. Okay, my final guest, Stephen Yu, Bluewell Growth Fund. Audience is yours. Ladies and gents, round of applause for our man, Charlie.
Thank you very much for staying until 4 p.m. now. So what I have got prepped is I want to share with you a little bit about my personal journey. So 20 years ago, I started my career at Huggins, and at the time I was involved picking fund managers. And at that time, obviously, that was between 2002 until 2007. And at the time, I have a lot of aspiration to become a UK fund manager because I met up with many exceptional fund managers at the time in that period. And so in 2007, I got my opportunity to become a UK fund manager. So I was a UK fund manager picking mid to large cap companies in the UK for about 6 years until 2013. And I would say, fortunately, I've then moved on. And I've gone on to looking after covering global companies at a previous hedge fund, and since then have started Blue Whale Growth Fund, which is a global strategy that we have about 2/3 in the US and with very small exposure to the UK. So how would I categorize my journey or experience through then is I would think the world has moved on from my personal perspective, of course. If that is not the case, I would think we would have many more companies that we invest into with the current strategy. There's a lot of things that have changed. I think people sitting in the UK don't recognize that. Not sure why, but people in the US would probably recognize that the world has moved on. And there's a lot to do with technology, with the cloud, with subscription, with the smartphone era, now with the Gen AI. And of course, if you look at the UK companies, that we don't have any of this, which is where the world is heading. And recently I spoke to some journalists about the British ISA, which obviously to me, I mean, hopefully no one's going to quote me on this, is a rip-off for anyone who have an extra £5,000. Because if I think about this, going back to Charlie's comments, that if you just were to pick a typical company, which most people do, or you just buy the index tracker. So what I have got in terms of data point is since we started running the strategy back in September 17 until now, 6.5 years now, the FTSE 350 index total return, including all the dividends we invested, had delivered an annualized performance of about 4% per year. 4% a year. I mean, just imagine inflation. So that's 4% every year for the last 6.5 years. If you have invested in the global stock market, let's say iShare, MSCI World Index, you would have got about probably 10% a year. About 2/3 of that is in the US. And if you have managed to invest into a fund, then we have done a few percent more. So we analyze about 14%. So what I was trying to say is when the tailwind is not, you don't have the tailwinds in terms of where the world is heading. It's a lot more difficult to deliver alpha. So if you ask me to try to deliver 14% per annum, picking UK company, I think that's impossible to do that because most companies don't give you that. It's just a lot more difficult. And the second point I want to make is like, what do we actually do? So I do agree with Charlie a lot that we focus into high quality businesses. So it doesn't matter where you find them, but where we have found most of our companies are in the US. And I recall this narrative about 2.5 years ago when Microsoft market cap just surpassed $1.5 trillion, about 2.5 years ago. There was loads of headline in the UK saying this is a bubble. How is it possible for Microsoft to be at $1.5 trillion is exactly the same size as the UK stock market, which we have a few thousand companies? That is a bubble. That is not right. Only about 2.5 years later, Microsoft is $3 trillion and still bigger than the UK stock market. The second time I've seen this narrative, as some of you might know, that we are a large backer of NVIDIA shares, which remains so. We have done very well on the back of that. And recently, I just saw a post on social media, also within the UK investor context, NVIDIA market cap just surpassed $2 trillion, which is the same size as the FTSE 350 index. That is a bubble. That is not right. People can make whatever comments they want to do, but the most important thing is you want to invest into a company that can make more money over time. You want to maximize the money-making opportunity through companies selling more of their products and services. Hopefully, they can dominate the world, which means that the TAM, they can sell more of their products are bigger than a company that are very limited to your own market. So we just ended up finding more of this company in the US, and I'm sure in the UK we have a few, but it's more difficult to do that. So I think with any investor in this room, I mean, you should start with a blank piece of paper, shouldn't have a home bias, and I would argue that every investor have a home bias. We have a home bias to the UK stock market because we all live here. The American would have a home bias to the American stock market, and they have done a lot better than us with the same home bias. So if you're in the wrong home, then your bias is going to cost you money. So that's my prep.
Ladies and gents, Stephen Yu. Have we got an audience member who's got one question, please? Thank you very much. And then we're going to open it up. We've got maybe 1 minute, I think, to grab one more question from the floor to any of the panel. Just say who that question is to, please.
Yeah,
this is one for
yeah, thank you.
For Stephen.
My question is about, what do you think about MicroStrategy and Coinbase as well?
Can I answer this outside of this room? It's probably not
We'll answer that
directly
outside of
relevant.
this room.
Yeah, not
Okay.
relevant for this conversation.
So
but-
we've got another question for anybody else on the panel, or a proper question for Stephen. Okay, just there. This one's for Stephen first, please.
Hi, Stephen. Thanks for your presentation. My question is quite a simple one. What effect do you think quantitative easing has had on the outperformance of the US market? And do you think that that's likely to reverse now that the macroeconomic picture is changing?
That's a great question. So I shared in my presentation just in the room earlier that so we did not do well equally. Our fund lost money in the first 6 months of 2022, and then we have recovered very strongly over the last 18 months, and we have managed to get above our high water mark. But what's important to remember was the drivers behind the level of underperformance in the first half of 2022, and of course that was due to quantitative tightening, not quantitative easing, interest rate going up at the same time. But when you look at the interest rate regime in July 2022, the interest rate has actually gone up until now. So if you look at the US 10-year in July 2022, it was at less than 3%. Now it's less than 4%. If you look at the real yield in the US, it was less than 1%. Now it's less than 2%. So the market or the company that we were exposed to, we have not actually got all the benefit or how we suffer in the first 6 months. So if interest rate does come back down, if we do get quantitative easing, I think we might make back some of those underperformance at the time. But the outperformance that we deliver was purely down to the company fundamentals or earnings power of the likes of NVIDIA or Microsoft, etc.
Brilliant. Brilliant reply. Thank you very much, Stephen. Ladies and gents, Stephen Yu. Going to take, I think we've got plenty of time for one more question, maybe two, from the floor, and tell me who the question is to, please. Who have we got? Anyone else going to stick their hands up so I can get them prepped for the next question after this one?
The US has been driven mainly by the Magnificent Seven, as they call it. What is the opinion of the panel about the other companies? Because really and truly, the market has grown by the Magnificent Seven only.
George, I'm picking on you.
Yeah.
How would you like to answer that, sir?
With words. I'll try with words.
Good man.
The Magnificent Seven, they're not expensive. That probably for me is the big reveal. They've got a great peg because they're delivering great earnings growth. I don't know if you sort of look through the NVIDIA results, but I mean they are stellar from a numbers perspective. If you're looking outside of it, we've had this sort of valuation gap for quite a long time with America, and that remains a constant. But the Magnificent Seven, the US sort of general techie shares, they're more expensive than UK. So I don't know, let's say on an EV/EBITDA basis, UK is about 15, the Americans are about 22. But in that, you can get massive pockets. So the most expensive Americans, oddly enough, they're in the sort of the data analytics side rather than on the AI side, so stuff like Snowflake, JFrog from database, MongoDB. So you can get very expensive ones out there.
Thank you very much. Thank you very much, George. I've got some from Gervais to add on to that as well.
I was just going to add on to that really, it keeps changing, doesn't it? Have you noticed how actually it used to be called FANGs and then it was FANGs Plus and AA and all the rest of it? I mean, if I just pick out the stocks which have been the top performers in my portfolio, they've done really well too, right? So I think there's a kind of narrowness there. And yes, the companies, they do go up, but boy, do they come down. I mean, Tesla was wonderful, but it's halved since 2 years ago, right? It's still part of the FANGs, the Magnificent Seven at the moment. And we're starting to see others coming under pressure now. We've started to see problems, not massive problems, but Google's coming off, Alphabet's coming under a bit of pressure for margin, etc. So they're fine at the moment. But I just think it's a fad.
Oh, interesting, interesting. We're going to take one question and then we're going to have to cut. Let's go there. Then we're going to call. Thank you ever so much for staying with us as well, ladies and gents. Really appreciate it.
Yeah, thank you very much for your
and
thoughts.
who's the question to, please?
Actually, to all the panelists,
Oh,
but
gosh.
maybe one sentence each. So if all of them could share one, their top idea for the next 3 years. And I understand everyone has constraints.
That's a question and a half, mate. You have to pay for that one. For charity.
But I can check their portfolios and
choose
see.
the charity you're going to donate some money to and I'll get them to answer.
Okay.
Okay. Stephen, do you want to go? One stock. It can be overseas, doesn't have to be UK. One stock.
I probably still would back NVIDIA just to make it simple.
Okay.
Make it simple.
Very quickly. Gervais, one stock, UK, go for it.
Yeah, I think I'll probably go Science Canode. It's a 30 million market cap. It's number one in Indian smart metering, and they're tendering for £1.1 billion worth of business at the moment.
Thank you very much. Charlie?
Tricky one stock.
Tricky.
I'll go for one that's had a really tough time, Croda, which is specialty chemicals. It's been hit by massive destocking. It's got a very, very interesting healthcare part of its business. It does drug delivery systems on new biological drugs that are coming. It's got very diverse positions across preclinical and clinical pipelines. Once those drugs come to market, it should do well, but you're looking at 2025 onwards for that. At the moment, it's still finding life a bit tough because those drugs haven't launched yet.
Thank you very much, Charlie. And yourself, George, just one stock?
Computer Centre.
Computer Centre, Computer Centre and Computer Centre from George. Ladies and gents, that's my panel session. Thank you ever so much. You can find all of these individuals on the Investing Matters platform, on Spotify, Apple, iTunes. They've all been interviewed before. Just find them on Spotify and go and listen to their previous interviews. Wonderful interviews, by the way. And there's another 60 others as well. So thank you very much. Take care. God bless you all.